I'm going to highlight three of the biggest risks Atlassian is facing right now. And then I'll look at the company's valuation and answer the question if I think the stock is still a buy despite these risks and challenges that the business is facing. I'll share with you my proprietary discounted cash flow valuation model, which calculates a fair value for the business today. And I'll look at the valuation on a forward price to earnings basis after evaluating three of its biggest risks. So let's start with the risks.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right. So first, I'm going to talk about macroeconomic headwinds and an enterprise IT spending slowdown that is a risk for Atlassian. For its fiscal year 2025, the company projected or forecasted 16% revenue growth, and that fell short of the 18.3% that was expected by Wall Street analysts. And whenever a company delivers a forecast that's shorter than Wall Street analysts are expecting, the alarm signals are sound and analysts are aware of a potential slowdown that they did not anticipate. So this shortfall reflects enterprises limiting expenditure on cloud software services amid higher interest rates and economic uncertainty. And of course, economic uncertainty has only increased since the start of 2025, following President Donald Trump and the tariff announcements. That's going to have an impact on the economy. It's likely to slow down economic growth. Now, Atlassian will not directly be impacted by the tariffs, but indirectly it could be as a result of enterprises slowing spending and therefore slowing spending on cloud software services. Right? Delayed cloud migrations are something that's been going on as enterprises have been more focused on artificial intelligence. And of course, it helps to be on the cloud if you're going to capitalize on artificial intelligence. But the focus has been primarily on artificial intelligence, and businesses looking at their budgets have prioritized spending on AI. In March of 2023, Atlassian undertook a cost-cutting program. Many businesses did these cost cuttings and restructurings in late 2022 and early 2023. Atlassian was one of them, cutting 5% of its workforce. It's always riskier when a business is undergoing this kind of transformation because you never know if they effectively undertook this transformation. The next risk I'm going to highlight is intensifying competition from developer operations and collaboration tools. Established competitors like Microsoft with GitHub, Google, and ServiceNow are expanding in these areas, trying to take share in these categories. The startups like GitLab and Asana are gaining traction, offering specialized solutions that compete directly with Atlassian's products. Now, pricing pressure is one of the reasons why you don't like competition. The presence of competitors offering competitor features at a lower price point or with more attractive bundling option limits Atlassian's pricing power, because if it tries to say to a customer, we're going to raise your price by 10%, that customer could say, well, then if you're going to try to raise my price, I'm going to move over to another provider that offers a similar service, maybe not as good, maybe a little bit different, but maybe at a lower price point. So it does take away your pricing power when competition starts entering the space. And lastly, organizational changes and talent retention risks. I highlighted earlier that Atlassian undertook that cost-cutting restructuring campaign. I would always rather have a business that's operating as usual, that's continuing as they've been continuing for the last 5, 7, 10-year time periods, rather than a business that's recently restructured. And that's because the restructurings don't always go as planned. There's a lot of imprecision in these restructurings. There's a lot of costs associated with those restructurings, and it hurts the labor force when they see their teammates and colleagues getting let go and the company is undertaking cost cutting, it makes employees feel like the business is going backwards and the business needs to cut jobs in order to increase profits rather than grow and increase profits by taking market share. And so people start to look for an exit. People start to keep their eye out and ask their friends and other workers, hey, if you've got a job opening at your place, let me know because I don't know what's going on at my place. They're letting go of some people, they're doing some cost cutting, and I don't want to wait to be one of the casualties of another one of these cost cutting programs. I'd rather get into another role before one of these cost cutting programs happens again. And so that really hurts talent retention, and you tend to lose employee morale when you have one of those situations. It's just one of the reasons why a business becomes more risky following these restructurings. All right, so now let's look at valuation. And this is my discounted cash flow model for Atlassian Corporation. I calculated the fair value of its business at $384. The current market price is $203. So according to my discounted cash flow model, this business does appear to be undervalued. And then when I went to FinChat and used their forward price to earnings calculator, looked at this business forward PE of 53, it's near the lowest it's been since 2016. So relatively speaking, looking at the forward PE, it also looks undervalued, as well as when I look at my discounted cash flow model, it looks undervalued. So despite the risks that the business is facing, and I highlighted those risks, they are meaningful. I have Atlassian stock rated as a buy, and I updated that recommendation on April 20th, 2025. I'm excited to announce a brand new private Discord to our channel members at the VIP Discord tier. It's a great place to directly connect with me, ask questions, and engage with a community of like-minded investors. Spots are limited, so join us today.